If you are 25 years old right now, and you max your TFSA every single year until you turn 65, investing entirely in a low-cost global equity ETF, here is the number you end up with. Approximately $3,400,000, tax-free. Not $3.4 million before tax, not $3.4 million minus a withdrawal penalty. $3.4 million that you can withdraw, all of it, any time, for any reason, and the CRA gets exactly $0 of it. This is not a hypothetical built on unrealistic assumptions. It uses the actual TFSA contribution limits Canada has used since 2009, a reasonable projection of future limits based on inflation indexing, and a long-run historical return assumption for a globally diversified equity ETF like XEQT. This video walks through exactly how that number is built, year by year, decade by decade, what it would take to actually do this, what happens if you start at 35 instead of 25, and what happens if you never max it at all. By the end of this video, you will understand the single most powerful, most underused wealth-building mechanism available to any Canadian. Before the math, a quick but essential refresher on how the TFSA actually works, because the rules are what make this projection possible. What it is: the tax-free savings account was introduced by the Canadian federal government in 2009. Despite the name, it is not just a savings account. It is an investment account that can hold cash, GICs, bonds, stocks, mutual funds, and ETFs. The savings in the name is a historical artifact, not a restriction. The core rule: every dollar of growth inside the TFSA, dividends, interest, capital gains, is completely tax-free. Every dollar withdrawn is completely tax-free. There is no income reporting, no T-slip for withdrawals, and no impact on government benefits like OAS, GIS, or the Canada Child Benefit. Contribution room: every Canadian resident aged 18 or older accumulates TFSA contribution room each year, whether or not they have opened an account. The room is set by the federal government annually, and it has grown steadily since 2009. Unused room carries forward indefinitely. If you turned 18 in 2015 and never opened a TFSA, your unused room from every year since 2015 has been accumulating and is still available to you today. Withdrawals restore room. The following year, if you withdraw $10,000 from your TFSA this year, that $10,000 in room is added back to your available contribution room on January 1st of next year, on top of the new annual limit. Over-contribution penalty: contributing more than your available room results in a 1% per month penalty on the excess amount. For every month, it remains over-contributed. This is the only real risk in the system, and it is entirely avoidable by checking your room on CRA My account before contributing. The cumulative total for someone who has been 18 or older since 2009, $109,000 as of 2026. Your action step: log into CRA My account right now and check your exact TFSA contribution room. Most Canadians have never checked this number, and many are surprised by how much unused room they have accumulated. Here is the vault from the opening: how the $3.4 million figure is actually built. The assumptions: a Canadian turns 25 in the current year and maxes their TFSA every single year from age 25 to 65, a 40-year period. For contribution limits from now forward, we assume the federal government continues its practice of indexing the limit to inflation, rounded to the nearest $500, which has produced limits ranging from $5,000 to $7,000 since 2009, averaging an effective growth rate of approximately 2% to 3% per year over that period. We project this pattern forward. Investment: 100% in a globally diversified low-cost equity ETF like XEQT. Assumed long-run annualized return: 8%, slightly below XEQT's historical return since inception, applied conservatively across a 40-year horizon that will include both bull and bear markets. The decade-by-decade build: age 25 to 35, years 1 to 10. Average annual contribution during this period: approximately $7,500, accounting for limit growth. Total contributed: approximately $75,000. Portfolio value at age 35, with 8% annual growth applied to each year's contribution: approximately $115,000. Age 35 to 45, years 11 to 20. Additional contributions: approximately $90,000 over the decade. Limits continuing to grow. Portfolio value at age 45, approximately $420,000. This is the decade where compounding starts to become visible. The portfolio more than triples, and a meaningful portion of that growth is now coming from the existing balance rather than new contributions. Age 45 to 55, years 21 to 30. Additional contributions: approximately $108,000 over the decade. Portfolio value at age 55, approximately $1,150,000. By this point, the portfolio has crossed the seven-figure mark. New contributions are now a small fraction of the annual growth. In this single decade alone, the portfolio added more than $700,000, while contributions only added $108,000. The market did the rest. Age 55 to 65, years 31 to 40. Additional contributions: approximately $130,000 over the final decade. Portfolio value at age 65, approximately $3,400,000. In this final decade, the portfolio grows by over $2.2 million. Contributions over this entire decade total $130,000, less than 6% of the growth. This is the power of a large base compounding at 8% for 10 years. Total contributed over 40 years, approximately $403,000. Total portfolio value at 65, approximately $3,400,000. Total tax-free growth: approximately $3 million. For every dollar contributed, the market contributed approximately $7.40 in growth, entirely tax-free. The visual that matters most: if you chart the portfolio's value by decade, the first 10 years look unremarkable. The second decade shows visible acceleration. The third decade is where most people would say, "This is really working." The fourth decade is where the portfolio adds more value in 10 years than was contributed across the entire previous 30 years combined. This is exponential growth, and it explains why the difference between starting at 25 and starting even 5 years later, at 30, is dramatically larger than 5 years' worth of contributions would suggest. Your action step: if you are in your 20s right now, calculate how many years until you turn 65. Multiply that number by the current $7,000 annual limit as a baseline. Understanding it will grow. That rough total, invested and compounding, is the foundation of your own version of this $3.4 million outcome. Now let us compare 3 realistic Canadian paths. Because the $3.4 million outcome only happens under one specific set of choices, and most Canadians follow a different path. Canadian A maxes the TFSA every year from 25 to 65. Total contributed: approximately $403,000 over 40 years. Portfolio at 65, approximately $3,400,000. Canadian B maxes the TFSA every year, but only starting at 35. Total contributed approximately $328,000 over 30 years, starting 10 years later, missing the early limits, but contributing at growing later limits. Portfolio at 65, approximately $1,580,000. The 10-year delay, despite contributing almost as much money in total, $75,000 less, produces a portfolio that is $1,820,000 smaller. The lost decade of compounding, ages 25 to 35, when the portfolio would have grown from contributions of $75,000 to a base of $115,000, costs more than 4 times its own contribution value by the time it reaches 65. Canadian C contributes inconsistently, averaging 50% of the annual limit from 25 to 65. This is closer to what most Canadians actually do, contributing when they can, skipping years during financial stress, never quite maximizing. Total contributed approximately $200,000 over 40 years. Portfolio at 65, approximately $1,700,000. Even at half the contribution rate of Canadian A, starting at the same age, Canadian C still ends up with a meaningful portfolio, because the early start captured decades of compounding on whatever was contributed. Canadian D never opens a TFSA, invests the same total amount in a non-registered account. Instead, using the same contribution pattern as Canadian A, but in a non-registered account subject to capital gains and dividend tax along the way. Assume an average 20% effective tax drag on annual returns. Portfolio at 65, approximately $2,400,000 instead of $3,400,000. The TFSA's tax shelter alone, using the identical contribution pattern and identical investment, accounts for $1 million of the difference between Canadian A and Canadian D. 1. Time matters more than amount. Canadian C contributed half of what Canadian A contributed, but still ended up ahead of Canadian B, who started 10 years later, but contributed nearly as much in total dollars. Starting early and being inconsistent beats starting late and being perfectly consistent. 2. The account matters as much as the amount. Canadian D contributed the exact same amount as Canadian A in the exact same ETF for the exact same 40 years, and ended up $1 million behind, purely because of where the investment was held. Your action step: identify which of these 4 Canadians you are currently tracking toward. If you recognize yourself as Canadian B, C, or D, identify the single change: starting earlier, contributing more consistently, or moving to a TFSA that would shift your trajectory closest to Canadian A. The $3.4 million projection assumes 2 things working perfectly together: maxing the contribution every year and earning an 8% annualized return inside the account. Let us address both, because neither happens automatically. What to hold inside the TFSA? For a 40-year time horizon, the right holding is a low-cost, globally diversified equity ETF, XEQT, at 0.20% MER, holding approximately 9,000 companies across global markets, is the standard recommendation for this purpose. VFV, tracking the S&P 500 at 0.09% MER, is the alternative for investors comfortable with U.S.-only concentration in exchange for a historically slightly higher return and lower fee. What should not be inside a 40-year TFSA? Cash, GICs, or savings deposits. A TFSA holding cash at 2% to 4% will never come close to the $3.4 million outcome. It will produce a result closer to the total contributions plus modest interest, perhaps $550,000 to $650,000 over 40 years. The tax-free wrapper is only as powerful as what is held inside it. Is $7,000 per year actually realistic for a 25-year-old? This is the honest part of the conversation. $7,000 per year is $583 per month, or roughly $135 per week. For many 25-year-old Canadians, particularly in high-cost cities, this is a significant portion of after-tax income. 3 realistic paths to closing the gap. Path 1. Start below the maximum, increase over time. A 25-year-old contributing $200 per week, $10,400 per year, exceeding the limit slightly in later years but starting below it. At 25, increasing as income grows through their 20s and 30s, can still approach the $3.4 million outcome by their 40s if they catch up during peak earning years. Path 2. Use the RRSP tax refund to fund the TFSA. A common and effective strategy. Contribute to the RRSP first, receive the tax refund, then direct that refund into the TFSA. At a 30% marginal tax rate, a $5,000 RRSP contribution generates a $1,500 refund, which becomes a TFSA contribution. This effectively uses pre-tax dollars to fund both registered accounts simultaneously. Path 3. Treat every raise as a TFSA contribution increase. As covered in prior videos on lifestyle inflation, directing 50% of every after-tax raise to the TFSA auto-contribution rather than to lifestyle spending is one of the most reliable ways to scale contributions toward the maximum over a career. The realistic average Canadian path. Most Canadians will not max the TFSA every single year from 25 to 65 without interruption. Career breaks, parental leave, periods of unemployment, large life expenses, all of these will create years of reduced or zero contribution. The data from Segment 3 already shows this matters less than people assume. Canadian C, contributing inconsistently at an average of 50% of the limit, still reached $1.7 million. The goal is not flawless execution. The goal is consistent direction, with maximum contribution treated as the target during every high-income or low-expense period of life. The non-financial discipline that makes this work. Automating the contribution removes the monthly decision entirely. Treating the TFSA contribution as a fixed expense, like rent, rather than a discretionary one, changes its priority in the household budget. And reviewing the available contribution room each January, to catch up where possible, keeps the long-term trajectory pointed toward the maximum. Your action step. Calculate your realistic monthly contribution capacity right now. Not the maximum, the realistic number based on your current budget. Set up an automatic transfer for that amount today. Plan to increase it with every raise, tax refund, or bonus, working toward the full annual limit over time. Let us translate $3.4 million tax-free into what it actually means for a Canadian retiring at 65. The withdrawal math. Using the standard 4% withdrawal rule on a $3.4 million portfolio, approximately $136,000 per year. Completely tax-free, indefinitely, with the portfolio historically expected to sustain that withdrawal rate for 30-plus years in the vast majority of historical scenarios. Compare that to the average Canadian retirement income. According to Statistics Canada, median retirement income for Canadian seniors is in the range of $30,000 to $40,000 per year, heavily reliant on CPP, OAS, and modest workplace pensions. A $3.4 million tax-free TFSA generates approximately 3.5 to 4.5 times the median Canadian retirement income, entirely tax-free on top of whatever CPP, OAS, or workplace pension also applies. The tax-free advantage compounds in retirement, too, because TFSA withdrawals do not count as income. A retiree drawing $136,000 per year from a TFSA experiences zero OAS clawback, faces no income tax on the withdrawal, and is not pushed into a higher tax bracket on any other income they may have. A retiree drawing the equivalent $136,000 from an RRSP or RRIF, by contrast, would owe substantial income tax on the full amount and would likely trigger significant OAS clawback. The TFSA's structural advantage does not disappear at retirement. It becomes even more valuable because it is the only major Canadian account where large withdrawals have zero interaction with the tax and benefit system. Optionality, not obligation. A $3.4 million TFSA does not mean a Canadian must withdraw the maximum. It means they have the option to. They could withdraw $50,000 per year and let the portfolio continue growing. They could withdraw nothing for several years and let compounding continue. They could use it to fund early retirement, a major purchase, health care costs, or to leave a substantial tax-free inheritance. TFSA assets transfer to a surviving spouse's TFSA tax-free, or to other beneficiaries with the account's tax-free status preserved up to the date of death. The generational impact. A Canadian who builds this TFSA and does not need to draw it all down can pass a substantial, entirely tax-free asset to the next generation, something that is far less efficient with an RRSP or RRIF, which become fully taxable in the year of death unless rolled over to a surviving spouse. Your action step. Imagine your own version of this number at 65, even if it is $1.5 million or $2 million rather than $3.4 million. Calculate 4% of that number. That annual figure, tax-free, with full optionality over how and when to use it, is the tangible outcome of every contribution made between now and then. Let's come back to where we started. $3,400,000. Tax-free. At 65. From maxing a TFSA every year from age 25. Now you know exactly how that number is built. The historical contribution limits, real, not hypothetical, from $5,000 in 2009 to $7,000 in 2026, accumulating to approximately $403,000 in total lifetime contributions across 40 years. A globally diversified equity ETF, XEQT or VFV, compounding at approximately 8% annually inside the account. 4 decades where the first looks unremarkable, the second shows visible acceleration, the third crosses 7 figures, and the fourth adds more value than the first 3 decades combined. And the comparison that should stay with you. Starting at 35 instead of 25 costs $1.82 million. Holding the same investment in a non-registered account instead of a TFSA costs $1 million. Time and account choice are not minor details. They are the 2 largest variables in the entire equation. At 65, that $3.4 million generates approximately $136,000 per year, tax-free, indefinitely. 3.5 to 4.5 times the median Canadian retirement income, with zero OAS clawback, zero income tax, and complete optionality over how and when to use it. You may not be 25. You may not be able to max the contribution every year. That is the reality for most Canadians, and the data shows that even inconsistent contribution from an early start produces a remarkable outcome. What matters is the direction. Open the account if you have not. Check your contribution room. Hold a low-cost equity ETF inside it. Automate what you can. Increase it whenever income allows. The TFSA is the single most powerful, most underused wealth-building mechanism available to any Canadian. The math in this video is not a fantasy. It is what happens when you use it as designed.